All right, guys, welcome back to the channel. It's a Friday. Let's keep it nice and casual. Heaps of data to get through today. All I'm seeing are signs of breakouts. Breakouts across all financial markets. I'll show you the data. I'll show you the charts today. Make sure you hit that like button and subscribe to the channel if you haven't already. And if you're new here, thanks for stopping by. Each of the day's analysis builds upon the previous day, so don't miss out on any of it. Let's get on with the macro cycle analysis. You were following me, Jason Pizzino, your home of macro cycle analysis. As I said, Bitcoin, crypto, stock markets, and real estate. Let's have a look at the major theory, at least that I follow, and from what I can tell, the markets follow. Here are some squiggly lines with real estate, stocks, Bitcoin, altcoins. Pretty simple. Money comes in. Let's do this for dollars. Goes into real estate first, then follows suit into stocks, Bitcoin, altcoins. Now, this is really simplified. It doesn't always go straight into real estate first. That's why I said it's really oversimplified. It can go into any of these first, but essentially what happens is the money finds its way back into real estate. And that's what makes up this 18-year cycle. Right? That's why it takes so long for the markets to boom to the peaks. And then when the major bust happens, it takes quite a long time. There is no 7 to 10 year real estate doubling sort of nonsense. That basically averages things out. But you see the majority of the gains happen in a few years, and then things go quiet for quite some time. And essentially all you have is people trying to tell us that the markets are going to collapse year after year. I see it all the time. I see it across YouTube, X, the media, obviously. Everyone talks about it. You got channels like this, years upon years upon years of markets going down, markets going down, markets going down, real estate, all this sort of stuff, right? But what we see in actuality are markets going up year upon year. When you look at the facts show that markets are going up year over year. When you look at the data, 33 out of 44 years, just taking it back to the 80s, you have markets up. So 75% of the time, the markets go up. So if you're into your bear porn and your fear porn and anything that basically catches your attention that the markets have to collapse and crash, 25% of the time, you could be right. Maybe even they pause, right? But the majority of the time, the vast majority of the time, you're going to be wrong. And you don't have to answer to me. It's the money in your bank account that you have to answer to at the end of the day. Maybe your wife on why you keep losing money in the markets. Just looking at the pure facts, they go up. And there are times that they go down. And of course, that's one big area that we're looking at towards the end of this major real estate cycle. So let's get on with some of this other data here. Looking at the 33 of the 44 years, typically we've got these couple of years here. Normally you would see at least another 1, maybe 2 years of positive growth in the stock markets, just looking back at the 44 years of data. It doesn't have to be so fantastic like we've seen the last 2 years, 24%, we're currently in 21% here. So we're not even finished this second year. So there could be another 2 years after this, 2025 and 2026. This particular negative year was 2022. You had another negative year of 2018, a 1% loss in 2015. You got a flat year here that was, I believe, 2011, and then obviously 2008. And so it's natural that humans run to this particular year. They look for major collapses often, and they don't happen often, just looking at the facts and the data. So essentially, I'm trying to prepare us for major moves to the upside, or at least the markets just grinding as they've been doing higher and higher to the upside. So what else is coming up? Median monthly flow into equity mutual funds and ETFs as a percentage of total assets under management. November seems to be a reasonable time that this occurs, thanks to Seth bringing up the data here. So essentially, I'm just looking at money coming into the space. It can come in to stocks, ETFs, any of the financial markets like that, comes into real estate. Eventually, all of the gains find their way back into real estate. That's where people take profits. And even as a business, businesses typically hold their real estate that they are, that they're running the business from. That could be anything like Amazon. It can be Apple. it can be Tesla. They own that land, right? And so wherever they go, the value of that land goes up. If you can understand this, you have the biggest edge over everyone in the market, because the majority of people don't understand this, or they don't want to believe that it's all interconnected. They think this runs separate to this, and they don't. It's basically just looking at the flow of money. So with that little mini lesson at the beginning, if you can really get that hammered home, that's how I learned about the 18-year cycle and how you can still see things continuing up when it just doesn't make sense sometimes, logically speaking, for the markets to go up. It just seems like they should be crashing. You've got a lot of other reasons why they should be crashing. In particular, we've seen credit card debt hit fresh highs in the US, total credit card debt balances in the US, quarter 1, 2018 and quarter 24. The reason I bring this up is because in 2022, we had a breakout to new, fresh, all-time highs for credit card debt. So that's 2022. Of course, there's 23 and 24, okay? You can see that behind my head. So it happened to be new all-time highs here in 22, then more all-time highs in 22, and the credit card debt kept going up and up and up. And you would see a lot of macro economists and that sort of thing pointing to these reasons why the market should collapse. And these things, I want to say they don't matter. They kind of matter. But if you can understand this, then you're going to be so far ahead of macroeconomists, analysts, anyone that talks about the market. It's crazy. And I know I've said that many times, but it's major, right? So they point to this thing, you got new all-time highs after new all-time highs, and eventually this piece of narrative disappears. And this is basically the cycle that goes around over and over again for the roughly 14 years up that the stock markets continue to go up, right? And you get these breakouts over and over and over again. And we just had another breakout for credit card debt hitting fresh all-time highs. I'm not saying that this is the reason why markets go up. I'm trying to explain that in the face of all of these narratives, and this is just one particular one that I saw come up and I remembered back from 22. Hopefully you are remembering history as well. And then it came up in 2023. It was a major narrative that a big reason why the markets should come down, because people are in a lot of debt, they're losing their savings, their savings are depleting, and there was a lot of comparisons to savings going down. They would show these charts like this and then point to it and say, well, savings are down, they line up with these recessions and so on and so forth, just trying to paint that picture that the market should collapse. And essentially, it goes out, no one talks about it anymore, and the narrative is lost. And people have also lost a lot of money waiting for these corrections. And I know I keep pointing to this one channel, I just can't be bothered bringing up the hundreds of other channels that do the same thing. This one in particular is on real estate. They're just finding the little areas that have all collapsed and basically pointing to those when the majority of the markets have been up. And I'll show you this here, the Case-Shiller Home Price Index. Again, breaking out. They've all missed it. That's something that I've got in the title here. I'm just trying to explain where we're going next. Case-Shiller Home Price Index. You could look at this. You can look at Zillow. You can look at Redfin. You name it. There is a chart of these things going up. This is just looking at the data from the markets, right? Where the majority of the money is. In this case, obviously it's real estate and the home price index. And sure, last month of the data we have here is July. August will be coming up soon. And yeah, it only went up 0.04% here on this chart. And maybe we do see a little bit of a cooling off here over the coming months, right? You got 0.1, then it went to negative 0.2, negative 0.3, negative 0.1, and then all of a sudden it jumps 1%, 1.7%, 1.3%, 1.1%. You get the idea, right? And so you've got this whole period of people waiting and waiting for further declines, the declines that don't really occur. And while they're waiting, they're missing out on researching the markets, they're missing out on entering the markets, they're missing out on a lot of things here. They're obviously missing out on future gains too. And then in a matter of 2 months, well, in a matter of 1 month, it wipes out all of those losses. And then the second month, bam, you're in profit there. So I know this is an oversimplified explanation of these breakouts and how these occur, but essentially human psychology, it's how we miss out time and time again with these markets. So here we are. I'm on Friday. Obviously, you guys might be watching on Thursday in the US, but we have another new all-time high on the S&P 500. Now, again, I'm not saying that this is going to keep booming higher and higher and higher, although that's what it's basically been doing for the last couple of weeks here, new all-time high after new all-time high. Yes, I'm still watching the volume profile here, especially on the futures market here, the S&P 500 E-mini futures. The volume is quite low as this thing climbs. This is really, really short term. You know, I'm more focused on the month, the quarter, the year as to where these markets are going. And there are still not many signs that these markets should collapse as we've been told over the last several years. Maybe this price action comes back to fill this. You'll start to see that fear. People will miss out again. And then eventually it builds and then breaks out. So the masses miss it again. They miss out on these opportunities to enter on any of these particular dips. And this is like a distant memory now. The yen trade, August, huge collapses here for the S&P. It was over. And of course it wasn't. So some other major breakout news, the bullish relative strength message from industrial stocks. Basically, just looking at these data points when this comes up, the S&P 500 after the S&P 500 equal weighted industrials triggered a range rank buy signal. So the industrials are triggering this buy signal. What happens to the S&P 500? Now, this is going back 19 signals to the 1960s, 60-something years, right? 12 months later, 94% hit rate, average max gain of 19%. So if you can imagine now until October 2025, an average gain, it sounds ridiculous, but look at the years that we're currently in, right? We're at 21% up on the year. Last year was 24% up, and that's usually thanks to big years down. So you get these big down, big up. Look at 2020 was actually a positive year, but you had a big move down and a big move up, remember? So here we are, 21%. Looking at this particular data here, there's your 19%. Now there was one year, 1987, with a 14% loss. So keep that in mind. However, looking at the probabilities, yeah, 19 out of 20 times, if I do my maths quick, you're going to get a better result in about 12 months' time. This is all leading to a peak, and I'm not permeable forever. There are times to be bearish. It doesn't seem like that right now, just looking at the particular data here. But of course, I put far more weight on the real estate cycle. Okay, I know we look a lot at this stuff, and of course, I'm going to get to Bitcoin and cryptos as well. As I said, I want to see these still doing well, so some of that money flows back over here for the time being, right? So yeah, just back to the data points, you get the idea here. This one shows you the max loss. So the point I wanted to bring up here was 1987 had a huge max loss, 30%. 2019, which of course was the signal occurred, and then in 2020 we had that huge drop in March, so about 25%. That was the loss. So the max drawdown. Obviously, it bounced back from that point, but the max drawdown was 25%. So another point, as I said, is people look for these black swan events. 1987 was that Black Monday, so the stock markets closed on Friday. Huge stuff happened over the weekend. I believe it was around October to 1987, and then they opened up like 50% down on Monday. Big things happened. It recovered and got to new all-time highs, right? 2020 dropped 25% over that period, and then of course recovered very quickly. If you're looking for black swan events, they don't occur as often as we're told, or as often as a lot of the media likes to point to. This could be a black swan, right? They point to these things that could be black swans. The definition of a black swan is no one knows. You don't know that there was a black swan until they found one. Correct me if I'm wrong, Aussies. Was it in Perth, Australia? They saw black swans, right? Point being, don't look for black swans every year. Just looking at this over the course of the last 40 years, basically a black swan every 30. And we can see black swans happen a little more frequently than that. Obviously, there was something in 2011. I could go through a few more. But yeah, it's not going to come up as often as people think. Next data, new highs versus new lows. So we've looked at 52-week highs. This one is looking at new highs versus new lows. Flash green for the NASDAQ and the S&P 500. We've seen NVIDIA get close to an all-time high. I believe it also potentially hit a new all-time high, right? So new highs versus new lows, really good signs here to see that the majority of the stocks are still hitting fresh highs. I would rate this one, this type of data higher than just the sector type of data, just looking at industrial stocks, right? You want to see the majority of the stocks moving to new highs. And there was also a big problem, the last couple of years. It's not necessarily a big problem, but the market saw it as an issue because there were less stocks moving to new all-time highs. If you remember back early this year in 2023, it was just the top 7 tech stocks going to new all-time highs. And now we're seeing a lot of stocks hitting new fresh highs. It's just all catching up, and that's what laggards do. They all catch up, which then leads to these bigger and bigger breakouts. Now, of course, I could go through the last 43 signals here. It's good to see a lot of data points that have come back from 1985, so just over 40 years of data points. 12 months later, 83% hit rate. When this occurs, you've got those new highs versus new lows flashing green, so new highs versus new lows. Then you're getting an 83%. So 8 out of 10 times, 12 months later is going to be higher again with a crazy average max gain of 29.9%. I went full Aussie on you there, 9. Average max loss, negative 3.8. So the average, it's not the max, but just the average. So it could be more than that. Keep in mind, this one here is about an 8 out of 10 hit rate. So 2 out of 10 times, it doesn't work. NASDAQ at the moment is within 3% of a new all-time high. So getting very close again after yet another big, fearful breakdown. All right, so we looked at this. This was the credit card debt hitting fresh highs. Gold breakout, new all-time highs on the daily chart. That was yesterday and the day before. Actually, this is Friday's action, so it's after hours, breaking to new fresh highs. $2,700 for the second or third time in history. So nice move up here. That doesn't mean it's always going to keep moving up and you're not going to see any of these, right? Corrections. I dare say you're going to see more corrections. I think you guys get that. But again, it's fresh highs building up. You can see it getting held down, testing, higher lows, breakout, test again, breakout, test again, and then away she goes. Silver, doing similar things here, but at a lower price point, or basically lower on the chart. It's still got to get back to its previous all-time high of 49.84, but it's building up. Look at the lower highs forming. Look at how it's starting to break out of those tops. Look at how it's sitting above 50%. This is where I bought some silver just as an exercise with the members. I posted about it to all of our members there in TIA Premium. If you want to learn more about trading and investing, setting up your plans, getting ready for more of these breakouts, check out the link, video description here, TIA Premium, subscribe, and you'll be on the free report. And when things come up, you'll be notified about that. So back to the data here. So basically I bought it at $18.65. Now it's up to $32. Remember, I got it in Aussie dollars. And the current price, it's up about 76%, possibly a little less because the Aussie dollar has been stronger. But nonetheless, 70% over a couple of years. Yeah, I bought it back in October 2022. Not bad. Bitcoin's better. But essentially, I bought it as an exercise based on the chart action here. I could see that it was hitting a low. It seemed like it was time for it to start moving. And yeah, that's basically what I was doing there. And posted it to the members to explain the reasons why. So other things that are looking like they're breaking or getting close to breaking out. I like to see the movement and how the pattern forms before the breakout. But of course, you don't know for sure if it's going to break out. But the title of the video is around the breakouts. I've shown you a lot of markets breaking out. Gold breaking out, the NASDAQ getting close to breakouts, the S&P 500 breaking out, silver breaking out of the previous consolidation zones. Right? It's not an all-time high, but it's breaking out of these previous consolidation zones. You can see it there on the chart. This time is the UK. So the UK stock market, also one of the biggest economies in the world, getting close to breaking out. You've got the all-time high right here at 84.80, higher lows, the spike lows here for August. And you can see that the market is basically still shrugging off bad news. Things will start to change if the market is unable to shrug off bad news. That low was the Japanese yen carry trade. Remember all that stuff that went off, and basically huge V-shaped recovery, kind of like what happened in COVID back in 2020. for the UK, not necessarily a V shape, but the US, you got a pretty fantastic V-shaped recovery right there. Bam, everyone was calling for major recessions. V-shaped recovery happened. Sure, they turned on the money printers, but that's life. The market is still seeing that as a positive. If the market sees money printing not as a positive, then that's time to be, you might find yourself with a bit of shit in your pants, right? That's the time to be a little bit more fearful. But for now, the market is still seeing higher and higher prices. So here we are. Cryptocurrency, fear and greed is at 73. Yesterday was at 71. And I made the comment here that yesterday was slightly higher. So here it is, green. And then you get this reading the following day on the fear and greed for the previous day. Okay, so higher close here at 67,600. It closed on the fear and greed at 71. Then today, well, the day that just closed down a couple of $100, 67,400. But the fear and greed was slightly higher. So just on a very small fraction here, small time frame, the market is seeing these lower prices just slightly lower. It was a down day, lower highs, lower lows. The close was slightly lower. It was a red day for you guys that follow your reds and the greens. The market saw this as there was still a little bit of greed in there, higher than the previous day. So maybe this is just, again, a little bit of a pullback before we start to see higher prices again, which leads me to the next point, or basically just the TA on Bitcoin at the moment. We're seeing a lot of these bear flag patterns, or at least I'm seeing it. Maybe you are as well. Maybe you spend a lot of time on X or on YouTube. Everyone's putting these bull flag patterns, basically a flag which should break out to the upside. I think it's important to note where to draw them from, because you could basically pull this up here and say, oh, we're not there yet. And that would still be relevant if you use the same rules every time that you draw your flags. But just sort of sticking a line on here and then maybe just joining it to wherever you want, it sort of skews the results that you will find. If you don't have a specific way to define things, the results are going to change all the time. And it might look good in a certain area, and then you move it and say, oh, it's the resistance is higher now, and it's lower here, but it's higher here. So I like to use the ones that are closest to the starting point, and then it has to have multiple hits along the way. And these make sense to me, right? It's how I use it. You can use it any which way you want, as long as you're getting results from using it the way that you use it. So from here, I see this as a breakout. Now, it'll be confirmed once we get back above roughly $72,000. But from here, I see a lot more strength in Bitcoin than what was going on further back earlier this year, right? In terms of the price, it really didn't spend that much time under $60,000. So although there was no chance of me calling that it would hit exactly 53 or 54 or 49 or even 52, like I'm not trying to call the price. In terms of an area for DCAing, I really did like areas under $60,000. And so now we can look back and see it in terms of time. There was less time spent under 60K, more time spent above 60K. So if we could catch these, then you're doing pretty well, I think. Hasn't been confirmed yet, right? But I think you'll be doing pretty well over the coming 6 to 12 months to ensure that you're getting the best entries if you're getting in, say, later and missed all of this period here while the market was expecting lower prices, or you're basically trying to add to your position. In which case, if you're adding to your position, let me remind you about your pyramiding strategies. So your pyramid can start here. It can could have started much lower, but essentially you want to be putting in the most money at the bottom and the least money at the top. Most money down the bottom, little less here, and then even less up here if you feel the urge to continue to buy up into the market. The reason for that is maths. You put too much in at the top, any sort of corrections wipe out all of the gains you've made along here, even if you've just been putting in little bits. You put too much in at the top, you're wiped out straight away, or at least you're wiped out of those profits, and all of that hard work you've done over the last 2, 3, 4 years is basically wiped out in a matter of days or weeks, because I think things are going to get even more volatile as the market moves up. So that's pretty much the TA at this point. I'm seeing a little bit of increased volume on the majority of exchanges. So I've just got Bitstamp here because it's the cleanest chart I've got. And in terms of bars, let's have a look at that. The breakouts are looking a little cleaner here. So any of these sort of down days, the volume's still a little lower. And the up days, they've been a little higher than the previous action. So it's not 100% confirmed yet. Obviously, the closes above 69 is what I've been referring to a lot for weeklies and monthlies, and then above the 72K, which was those previous tops. That's going to give us a little more confidence. And how the market moves until those breakouts, that's going to be clean. Basically, the market action is going to be cleaner above 72, but from here, it's not as clean. And I'll show you the example going back to last September and October. You can get the breakouts, right? It's starting to break out of this range of 26K, but then it comes back and tests it. It breaks out of 27, 28K, comes back into that zone. And it's not until it gets past the previous resistance levels that the moves get a little bit cleaner, and you're able to see that the daily chart, look at the swing here, it barely breaks down. You get this whole move up from 26 up to 44 without the daily swing chart breaking down. And that's this here, the TIA Gann swing indicator, 7-day free trial, link in the video description if you want to use that for your own trading. It helps you get into trades and know where to put your stop losses and take profits, or well, as I said, put your stop loss in case it goes against you. In this case, right around here, right? It's just pulling down. So on those breakouts, they get the movements get much more clean once they get out of those key resistance levels. And so as we climb back to 72 or 74 here, these moves, ideally, looking at the history, that's just one example, should get a little cleaner. This is the time where they're not as clean, which is why people second guess the market action. But we've come to you with the overbalance in time and price. We've looked at breakouts of diagonal downtrends. We've looked at the 50% level. So lots of other indicators and signals that we use in our trading plans to help us identify the direction of the market. So it seems like a breakout is inevitable. Big words, I know, but we'll continue to follow and see how we are chasing along. So that was the fear and greed. That was the Bitcoin analysis. I've got another major. This one, I think this is really going to be really, really important. The USDT dominance. So we've hit this level now. If you've been following over the last couple of weeks, obviously you guys that are subscribed, hit that now if you haven't already, and hit the like button. Anyway, short-term weekly was the resistance. So we had the minor bounce into the resistance and then breaking of support. So that's the next thing on this list here. So we hit that resistance at 50%, back down to the support here at 5%. If this is to break down, probably some good fireworks for BTC and potentially some of those altcoins, which are just waiting to pump. That's the dominance here, the USDT dominance. It isn't looking the strongest, especially getting rejected off a major 50% level at 6.6. So that's the overall downtrend, 50%. If it's breaking above that, that's going to be very bad for Bitcoin and cryptos, because more of essentially crypto money is going to flow back into USDT. But a breakdown around here right now at 5.2 could be pretty solid for BTC and, like I said, some of those altcoins. So keep an eye on this. Put your alerts in here if you wish, but this is probably going to be pretty significant. Now, it's been a couple of videos since I've gone into Ethereum and Solana. Just looking at ETH BTC on the weekly chart here, I still think it's several weeks away until we find a low for ETH BTC, and maybe the saving grace for Ethereum this cycle are memes. Whether you believe in a meme super cycle or memes in general just doing their thing, everyone trying to get into them, a lot of them are going to be on Ethereum, and of course, probably even more so on Solana. But that could be part of the saving grace here for Ethereum, at least in this cycle, because at the moment, still not many signs for ETH BTC to really recover from this point, besides 1, 2, 3 bottoms, but the highs are still getting lower. So still quite weak on the weekly chart here, looking at the Gann swing indicator. So yeah, if that breaks down, well, then you got to start looking towards around the mid 3%. So that's ETH versus BTC. In terms of timeframes, we've covered this from 2 previous cycles, where we are now to the election and then post election, looking at roughly 7 to 8 weeks from that election point to get to a very significant low. In the 2 previous cycles was a higher low to the lows, whereas in this cycle, potentially going to be the low. So yeah, not looking too strong for ETH. And if this is to recover, plenty of overhead resistance back at 4.5%, 5%, 6%. I dare say it could be a pretty dire one for ETH with how weak this has gotten. Hopefully it's not. Hopefully we get some big bounces here and ETH takes off again. We'll just wait and see. Now, Solana is the other one here. It still hasn't broken down from the diagonal uptrend. It still has a little support here at 0.0021 and then the 50% level back at 0.0018. So either way, it does have some work to do to get back into a better, strong position. It still hasn't broken down, so it's, it's in the middle here. But yeah, that level at 0.0026, that's the goal for Solana versus BTC to get back into that strong position. Either way, it's still looking stronger than Ethereum. And you'd probably argue that it would do better than Ethereum this cycle just based on, well, I guess if your narrative is around the meme coins and that meme super cycle theory, obviously more of it being on Solana and more interest on Solana, etc., right? So that's BTC from this point. I think we've got the breakouts coming Q4. I've looked at Q4 or Q1. I'm starting to lean more towards Q4 here, just based on a few of those things that we've looked at. And if that's the case, then alts, memes, whatever, altcoins will potentially start to break a little bit earlier than where I was looking sort of around mid to late Q1 of 2025. Obviously, things can change on a dime. If this breaks down underneath roughly these tops here at about 64, 65K and holds under those levels, that could hold things up for a little bit longer. So that we'd have to push those timeframes out again. But for now, with that strength, and as we get into the weekly closes, anything above the 65, 66 for now is a good start. Then we cover 69, 70, and then 72. That's going to put it into a really strong position. And I think some of that strength is going to flow down into the beloved altcoins. So thanks for watching. Like the video. Have a fantastic weekend. And I'll be on X and Instagram this weekend if you want to touch base over there. Until then, take care and peace out.